Okay, so here we're continuing our discussion of AUC Section 315, understanding the entity and assessing the risk of material misstatement. So in the past couple sections, we've been looking at the components of internal control. And so in this particular video, we will be looking at the information system, which will be third component of internal control after the control environment and the risk assessment process. So it says here that we should obtain an understanding of the information system, and that includes the related business processes relevant to financial reporting, and that might include these areas here. And so we would want to understand the business processes for the class of transactions and the operations that are significant to the financial statement. So they're major financial statement transaction classes. The procedures within both IT and manual systems by which the transactions are initiated, authorized, recorded, processed, corrected, and transferred to the general ledger. So we want to understand that process. We understand what accounting records support the accounting process and these items here, and how the information system captures the events and conditions other than transactions that are significant to the financial statements. So for instance, maybe subsequent events or related parties or something like that. It's technically not a transaction, but it's also important for the financial statement. The process for reporting accounting estimates and disclosures in the financial statements, and also the controls surrounding journal entries, especially the non-standard journal entries, for instance, non-recurring or unusual ones. And so this understanding of the information system relevant to the financial reporting should include relevant aspects of that system relating to information disclosed in the financial statements that's obtained from within or outside of the general and subsidiary ledgers. We should also obtain an understanding of how the entity communicates the financial reporting roles and responsibilities and significant matters relating to the financial reporting. So that would be like communications between management and governance, and also external communications, such as those with regulatory authority. So basically, we want to gain an understanding, start to finish, of major of how the information gets from the transaction or any other event and into the financial statements or other reports, and eventually into the hands of management or those charged with governance. So we want to understand that entire process. And we've got some explanatory material here, section A93 through 101. So let's go down to that section and see how they can add to this here. Okay, so now we're in the explanatory material section where we're talking about the internal control component of the information system. So we saw before that the information system relates to the business processes relevant to financial reporting. So that means, the information system relevant to financial reporting objectives means, or consists of the procedures and the records that are designed to do the following: initiate, authorize, record, process, and report on transactions, resolve incorrect processing of transactions, process and account for system overrides, transfer information from transaction systems to the general ledger, capture information relevant to the financial reporting that's not necessarily a transaction, and also to accumulate the information that we need for the financial reporting to include in our financial statement footnotes, for instance. So this first one we might equate with, just processing cash transactions, paying bills, recording revenues and such. But in that process, there might be errors that need to be corrected. So we would want to understand how that ends up happening. Also, there might be situations where it's not a run-of-the-mill sale or purchase, and so for that there would be perhaps overrides or bypasses of controls to record those types of transactions. Also, we might have software systems that we pull information from to put into the general ledger. So for instance, we might not record our sales directly into the general ledger. We might have a software that accumulates all the sales transactions for us, and we print a report from there and put it into the ledger. So we would need to understand how that process works as well. And then also, as we know, throughout financial reporting, there are certainly transactions or things that we need to record that aren't necessarily run-of-the-mill transactions. So for instance, recording depreciation, maybe there's estimates that we need to make, maybe we need to make allowance of receivables, that sort of stuff. So that would be encapsulated in this paragraph. And then after all of these transactions are made, we need to understand how do they get into the actual financial statements. So that would encapsulate this paragraph here. So we're basically want to understand, start to finish, how does financial information get into the financial statements. And of course, we saw before that this would be the major transaction classes. So we don't have to know how they do things for immaterial accounts or really small things, but the major transaction classes, for instance, the revenue process, the payroll process, if a large part of their expenses is payroll, or if it's a manufacturing company, perhaps the cost of goods sold part and how the inventory process works would be major to us. So this all gets into the financial statements, but there might be information that we put in the financial statements that's not part of the general ledger. So for instance, we didn't necessarily record it in our general ledger or our accounting records, but somehow that needs to still get into the financial statements. So there's got to be a process for how they do that as well, and we need to understand it. I have a few examples here. So for instance, there's a requirement to have a footnote that lists the future lease payments on non-cancelable leases. So we need to understand how they figure out what those amounts are. We've also got fair value information. So they obtain that outside of the financial statement. So for instance, maybe they ask their broker what the fair value of certain investments are, or maybe they have a valuation perform. If they have certain models that they use to determine financial statement information, then we need to understand how those work and where they get the inputs, the assumptions they use. A few other examples might be different analysis they use for the financial statement models, information they get from the tax returns. So we need to understand how they determine perhaps the deferred tax asset or liability, and also how they determine that the going concern assumption is reasonable. So these are just examples. There's certainly a lot of things that go into the financial statements that might not be listed here, and so we need to understand what those are. And this definitely we learn somewhat from the other components of internal control as well. For instance, they have an example here that we might learn about some of the footnotes that are required. For instance, the ones about credit risk, liquidity risk, market risk, etc. We might learn that from the risk assessment process, which is another internal control component. So, as we've noted before, we're not required to obtain an understanding about every possible thing that goes into the financial statements, but the major items. And so certainly, we would need to understand how journal entries happen as well. For example, if they record journal entries to record the sales and maybe a bulk journal entry to record the sales for the month, for instance, or purchases, that sort of thing. We would need to understand how they determine those amounts and make sure that they're accurate. And those would be standard journal entries. There might also be non-standard journal entries, which would be ones that are unusual or non-recurring. And so we would need to understand how they determine those amounts and whenever they arise. And so next, they talk a little bit about the related business processes. If you remember, we're required to gain an understanding of the information system, which includes the related business processes related to financial reporting. So they're telling us here exactly what are related business processes. And those would be activities that are designed to develop, purchase, produce, sell, and distribute entities' products, ensure compliance with laws and regulations, and record information, including accounting and financial reporting information. So these business processes result in the transactions that are recorded. So if we understand these processes, then we will understand how the transactions get into the books, and it will give us a better understanding of how to assess our risk of material misstatement. And finally, we are required to gain an understanding of the communication within the entity. So how does the financial information get to management and to potentially those charged with governance? And also how each person who's involved in the financial reporting process, how they enforce their responsibilities and the activities they're required to do and how it relates to the activities of others. In general, how do they communicate throughout the process of producing the financial information in the financial statements? For that, we can look to perhaps policy manuals or financial reporting manuals to get a good idea of how that works.